Hello. European stock markets weakened today after the release of UK GDP data. The UK economy contracted by 0.5% on a monthly basis in July, worse than the expected 0.2%, as strikes in hospitals and schools weighed on output. Rising expectations of another European Central Bank rate hike is also putting pressure on stock markets. According to a Reuters report, the ECB expects inflation to stay above 3% next year in its updated forecasts, far exceeding the 2% target. Oil prices edged higher today, boosted by the bullish demand outlook by the OPEC monthly report stating that oil markets will tighten further this year amid robust demand and lower production. The report also stated that global oil inventories were expected to fall by almost 500,000 barrels a day in the second half of 2023. Gains were limited, however, as data from the American Petroleum Institute showed that U.S. crude inventories rose 1.2 million barrels last week, suggesting that U.S. fuel consumption may be cooling after a strong summer season. Also limiting oil's gains and affecting commodity prices was the increase in U.S. Treasury yields today, with the U.S. 10-year bond yield up by more than 3 basis points and hovering around the 4.3% level at 7 a.m. Eastern Time. The surge reflects traders' concerns of another rate hike or a later start to the rate cut cycle. Following today's Consumer Price Index data, investors will be looking out for tomorrow's Producer Price Inflation data release. Apple shares dipped today after the tech giant revealed 4 new iPhone models at its annual hardware refresher, but refrained from launching major updates to the design or software. Apple has been strategizing to slow a slide in revenue in the last 3 quarters amid a global slowdown in the smartphone market, concerns of Apple's demand and production in China, as well as rival firm Huawei's new updated smartphone is also weighing down Apple's shares. As PhillipCapital team, we wish you happy and healthy days.